So welcome to our webinar on selling your business should you consider private equity. We've got a lot of people signed up today, so obviously indicative of what an interesting topic this is to people. So looking at the attendees, I think most of you probably do know MKS already, but for those of you who are less familiar, MKS are a top 15 firm of accountants, tax and corporate finance advisors. And the firm works across a wide range of different commercial sectors, as well as not-for-profit and private clients. But in our West End office, we've got a team of 7 partners and 100 people who specialise exclusively in working with media, marcoms and tech clients. We're also part of the more global network, which has got presence in over 100 different countries, so very well positioned to help our clients with international growth or international M&A. So the media M&A market has been reasonably active over the last sort of 18 months, despite all of the COVID challenges. And I suspect if there's an announcement in CGT rates going up, it's going to be even more active between now and next April. But more interestingly, in Q2 of 2021, some 53% of deals done in the M&A sector were actually private equity backed deals. So PE houses really are sort of seeing the potential across these sectors and indeed are prepared to pay very competitive prices for ambitious and fast growing businesses. However, I think it's fair to say, you know, from my experience of talking to clients, there's a bit of mystery around how private equity houses work, how they behave, to the extent they get involved after the deal, what their own exit plans are, what sort of returns they're seeking. And certainly when I'm discussing exit strategies with my clients, there are many who will sort of screw their face up at the mention of private equity being an alternative, sort of instantly just discounting it. And that's often from just complete sort of lack of understanding or from sort of, you know, anecdotal stories they've heard down the pub. So in this webinar, we are going to aim to debunk the myths and uncertainties around PE and explore why PE is an attractive option for any business looking to sell or grow. So there's going to be a panel discussion where I'm delighted to be joined by guest speakers Matt Harper, CEO of Marketing Practice, and Adam Lewis, founding partner at Horizon Capital. And they're going to offer their insights having sat opposite sides of a recent transaction. And Damien Ryan, one of our corporate finance partners, is also going to add his perspective, having been involved in M&A deals over the years. But firstly, Dan Lehman, one of our corporate finance directors, is going to provide an update on M&A activity and key trends over the last quarter. He's going to spend about 10 minutes doing that. Just to let you all know, though, we are going to be recording, or we are indeed already recording this webinar, and it will be sent to you afterwards. So please do feel free to share it with your peers and your colleagues. So Dan, if we could welcome you on the screen. And hopefully the screen share will work and you can go forth and present.
Yeah, hello everyone. Lovely to be presenting to you all, and thank you, Esther. I am going to try and share my screen, and hopefully Esther will tell me it has worked. Bear with me a second. Hopefully you can all see my screen perfectly and not see yourselves again, so that's good. In the media and marketing services corporate finance team, we track quarterly deal volumes in the sectors that we cover, and we've been doing this for quite a long time. And I just wanted to share with you sort of initially the highlight of what we've been seeing. So as you can see from the graphs on the table there, it's very clear that when the pandemic hit in 2020, deal volumes instantly halved in Q1 2020 and fell further in Q2 once lockdown hit and fell to a low of 37 deals in the quarter that we recorded. What's happened since then is reassuring, and we've seen deal volumes increase every single quarter since then. Q1 2021, while still lower than Q1 2020 and Q1 2019, continued that trend. But what's really nice in Q2, it's for the first time we've actually almost seen deal volumes pick up to pre-pandemic levels. So in Q2 2021, we recorded 79 transactions, which is on a par with the 80 transactions that were recorded pre-pandemic in Q2 2019. So we're seeing a real pickup, and it's worth saying that our team are seeing a lot of activity of businesses going to market in Q4 and transactions happening. So hopefully we would like to see this borne out by the numbers and continuing to happen as we get the numbers for Q3 and Q4 later on. Right. Quarterly deals by sector. One of the other things we track is what kind of media and marketing businesses are dominating the makeup of the deals. And it's quite interesting actually, because again, we're seeing a similar situation where Q2 2021 is quite similar to Q2 2019 pre-pandemic, where we're now seeing just over half of deals are in the marketing services sector. In Q2, it was 2019, it was just under half. We're again seeing a third of deals being in the media tech area, which remains a high growth and popular sector. We saw similar from Q2 2021 to Q2 2019 levels of publishing deals. And we've seen a slight shrinkage in TV, film and entertainment deals, but that may be because of how those sectors were impacted by the coronavirus. And now that James Bond is being released tomorrow, hopefully we'll start to see more activity in TV, film and entertainment as well in later quarters. Digging deeper into the marketing services sector itself, it's worth noting how that splits, because not all marketing services businesses are as popular for transactions as others at the moment. The really hot subsector is digital, which made up 60% of the marketing services transaction deals. Advertising continued to remain a transacted sector as well, with 17% of deals in Q2. PR at 12%, and there's been a couple of notable PR deals that I'll call out in a little while, has also remained busy. And then design and market research have made up the balance of which areas were being transacted in Q2. But the big message is that digital has remained an ever popular and important sector for M&A in Q2. What is really interesting and is very in line with the talk we're going to have in a minute, the panel discussion, is what's happened to the type of buyers that have been making up the acquirers of transactions. And this is where there's a big change and an increasing trend here. So if we think back pre-pandemic in 2019, as you'll see from the graph here, the makeup of acquirers was sort of around a quarter, just under, I suppose, on average. In 2019 were PE-backed transactions. What we noticed during sort of 2020, when lockdown was in full force and coronavirus was really impacting the world, we saw that it was in the 40% of deals were PE-backed. And what's really interesting is we're coming out of the pandemic and businesses are hopefully finding life slightly more normal. The trend has continued, and PE-backed businesses are over 50% of transactions now. So it really stresses the importance as a potential, if any of you are potential sellers of your businesses, that if we don't consider PE as potential buyers, then we're losing over half the buyer pool that are out there at the moment by transaction volume. So the number of deals and the importance of PE in the M&A market, in the media and marketing services sectors, is just increasing at the moment. Sort of to put some flesh onto the bones of this, I've picked out some selected transactions to talk to you about. And first of all, I'm going to pick some notable ones across Q2 and Q3 that are PE backed, and kind of give you a flavor of how this is working and probably why PE is dominating the numbers, as it were. And I guess what you'll see on this slide is numerous people, but there's probably 3 individual direct investments by PE on here. There's a very large equity investment by Vista Equity Partners into Triple Lift, which was a $1.4 billion deal for an ad tech business, sort of showing the theme of that being very popular. There's also Horizon Capital, who bought into the marketing practice, which I'm not going to talk about because our panel will do a far better job of that. And LDC made a direct minority investment into Headland, which is a communications business. So they're direct ones, but what you see in the sort of PE-owned businesses is numerous transactions. A lot of these people are building their capacity inorganically through acquisition and doing it quite quickly. So just in Q2 and Q3, you know, the marketing practice, which again, I'm not going to speak too much about, have acquired 2 businesses there. Brain Labs, who are owned by Living Bridge, have made 2 acquisitions there, Molesey and MediaNet, and Sideshow, who are owned by Waterland PE, have made 3 acquisitions. And Fisher Wack, who I think are also a LDC-backed business, have made a further acquisition of Closer Look. Now, as you'll see there, the multiple acquisitions by PE-backed businesses is partly what's driving the numbers in a way that wouldn't necessarily happen at that pace by trade buyers traditionally. The other thing to say about this is, you know, aside from Vista Equity, with Triple Lift, which was the ad tech, and Headland, which was the communications business, pretty much all the other businesses on there as targets are digital businesses. Or, you know, whether it's, you know, Amazon specialists, whether it's conversion specialists, whether it's data and performance marketing businesses. But they're all digital in nature, or digital native, as some of them describe themselves. So it really also supports the trend on what we've seen in the numbers on the digital importance as a sector. And I'm going to finish off by briefly touching on some non-PE businesses. It would be remiss not to talk about the big networks, but actually Q2 was really quiet for the big networks, and really the notable transaction was Publicis' acquisition of Taylor Herring, which is a PR communications business. So that was, but that wasn't all we really saw from in Q2 from the big networks. Next 15, which is a listed group, bought a couple of businesses, Shopper Media, who again have digital capabilities, and also Next 15 subsidiary Savanta, which is an insight business, bought YouthSight, which is the UK's largest panel for youth access research, which has got about 150,000 registered people on it. So again, continuing that theme. And then S4 Capital, which is Sir Martin Sorrell's vehicle that's listed, bought Raccoon Marketing, which is a Brazilian-based digital marketing agency to expand their South American capabilities and footprint. But again, you'll see that again digital has been important, and there's been some PR deal there with Taylor Herring. It's also probably worth mentioning that's just happened and hasn't made it onto my slides, but I know that Strat7, who Horizon have also invested in, who are an insight and data group, have made an acquisition today of Insight from Kinnan Carter. So congratulations on doing that, and that will hopefully make it on our next update slides. And on that note, I will hand back to Esther. I can stop sharing my screen.
That's great. Thank you very much, Dan. I think that, you know, those numbers and those charts bring into sort of sharp focus how, if you're not considering PE as a potential buyer, you are sort of cutting out a big chunk of your potential buyers. So moving on then to the panel discussion, I'm delighted to welcome our panelists. So if Matt, Adam and Damien want to turn their cameras on. Matt is the CEO of the marketing practice, one of the leading B2B marketing agencies. They're headquartered in the UK, and they also have offices in the US, Germany and Australia. And Matt's been with the business for nearly 10 years and led TMP through their sale to Horizon, which completed in March this year, so still pretty fresh. And Matt's role is now to lead the business on the sort of PE growth journey, which will involve a significant amount of both organic and M&A growth, which I'm sure you'll talk about a bit more in a minute. Adam Lewis has invested in fast-growing entrepreneurial businesses for over 13 years, helping managers and entrepreneurs grow their businesses both in the UK and internationally. And he is a founding partner of Horizon Capital, who are known for backing ambitious buy and build strategies in the tech and B2B services sectors. And last but not least, Damien Ryan, one of our corporate finance partners who specialises in media and tech businesses. And Damien has built and sold several of his own media businesses. And so he's seen sort of firsthand how M&A really is a highly emotional process, and understands that it is fundamentally all about the people and the relationships, regardless of whether you're working with global brands or innovative startups. So I'm going to be asking the panel a number of questions that I have, but please, please, please do ask your own questions. And also, please, please, please do put them in the Q&A function, not the chat function. It's much easier to keep track of them if they are in the Q&A function. So just pop them in there and I will try and weave them into the discussion as we go through. So Matt, I'm going to come to you first. So obviously you've recently been heavily involved in the sale of TMP to Horizon. So can you just talk us through a little bit about the process of getting that investment and how you went about choosing your private equity partner?
Sure. Yeah, thanks for having us as well, Esther and Kingston Smith team. Appreciate it. Yeah, I mean, it's quite interesting hearing those slides and the research and sort of seeing the volume of insight that's out there, because I think yeah, we didn't go through a hugely rigorous process in looking for the right partner. But what we did do was we reached a point where we knew we had a handful of options for how we'd move the business forward. We're sort of vaguely aware of private equity being an option. It hadn't been something we'd sort of seriously considered before, partly because of the reputation that I think private equity has. Sorry, Adam. But you know, the sort of connotations that came from those words, I suppose. With the trade bit was very real to us because, you know, we'd had taps on the shoulder 2 or 3 a year from the holding groups, the big network agencies. And had lots of conversations in the past with some of them. So we knew that was a very real option. And then our third option was, you know, to go more organic about it, maybe look for some sort of funding or investment sort of more independently that we could drive from the banks to go on a journey. And I think we settled on the PE option quite quickly, actually. And I'll talk a bit about kind of why we settled on that and then how we chose Horizon. Firstly, it was a sense that from all the conversations we'd had on the trade side, it just didn't feel right in terms of the cultural value, but also the articulation of value to our clients and our people. And that's always the kind of, I think, the acid test. Like, I picture standing in front of my team, you know, on the day we announce an acquisition, and what am I telling them? And am I really convinced in the story that I'm telling them that it's right for them and right for our clients? On the trade side, we just never got to a point where we found that was quite right, partly because we knew that we would lose an element of focus in going down that route, you know, an element of sort of the principles that we founded the business on, the real focus and specialism that we had. And what private equity gave us, or we started to see it gave us, was an opportunity to go on our own journey, to follow a path that we were already on, but basically be sort of supercharged in doing that, and with the sort of investment power that private equity can bring behind us. And so it allowed us to capitalize on the fact that we had a really highly motivated management team that really wanted to keep going and push on and be more ambitious in the future, and to own that journey ourselves. So it was sort of serendipity that we met Horizon about the same time as Clive, who's the founder of TMP and the previous owner. He and I had started talking about this, and we met the Horizon guys through a mutual contact. And I think the reason we settled quite quickly on them as the right partner was just the volume of diligence we did to speak to other investments, you know, other CEOs, former owners, some of them through the front door that Horizon introduced us to, some of them through the back door, people we knew. You know, we really wanted to get some good insight into who Horizon are and how they work. And I was quite passionate as well about speaking to businesses that had maybe been through difficult times because the big thing I was worried about was, again, going back to that whole private equity reputation. If we do have a difficult quarter, if we do have a difficult month, what happens, and how do they respond to that? So we did quite a lot of diligence talking to other investments to understand how they operate, and through that became a really consistent story about the sort of quality of the team and the people and the principles. So that was how we sort of settled on them as the right partner, was partly serendipity and then also just a genuine sense of cultural connection.
That's great, thanks. And what about you, Adam? What attracted you to the sector generally, I suppose, because you've got investments in both TMP and Strat 7, which are sort of going great guns and making acquisitions, but sort of what attracts you to the media sector generally?
Yeah, at a macro level, we think it's a really interesting place to invest with really strong drivers long term. So not only are the markets large, but the UK is one of the leaders globally in that market, and there's an ecosystem of really strong entrepreneurial, innovative businesses here in the UK with some great teams to back and partner with. And I'll come on to it, but private equity is fundamentally a partnership. It's a people-based game. You have to build a close partnership to build a successful outcome. And we think there's a rich pool of talent in this market to back and work with. Secondly, it's very fragmented. We'll come on to what we mean by buy and build as a strategy, but effectively backing our portfolio companies to make further acquisitions, as we've done with Matt, and we've been very quick out the blocks with 2 acquisitions in the first few months. Strat 7, who've now done 3 acquisitions in the first 2 years, with another one closing soon, as a way of building value and maybe accelerating, achieving a goal a bit quicker than a founder-owned business would otherwise be able to. So there's a strong backdrop of fragmented, growing market to play in. And I also think from a customer perspective, an openness and an increasing openness to considering and buying innovative service providers from smaller, more agile, tech-enabled service offerings and outside of the big global conglomerates. And we're seeing that certainly in our portfolio, where we're able to establish a foothold into very, very large customers and be pulled internationally within their groups as they look for more innovative thinking outside of the large established players.
I mean, Adam, Matt mentioned that they got tapped on the shoulder by some of the big networks, which typically happens once you reach a certain size threshold, and if you're showing strong growth. I mean, would that be a similar way to the private equity houses working? You're kind of literally eyeing people up and going and having proactive conversations with them, or would you wait for them to come to you?
So we take quite a proactive approach. We like to really understand the market, go in as an informed partner. Money is money at the end of the day, but for us, it's important that we can bring something to the table and come with a viewpoint that we can test with the founders and see if there's a shared vision and a shared thesis to pursue, which we really connected with Matt and the team around a shared vision. And have made excellent progress there, similarly at Strat 7. So vast majority of investments we make are founders who probably always thought they'd sell to trade. They don't necessarily have an understanding of private equity. They're perhaps suspicious of it because of headlines they've read in the last 10 years about mega consumer-led buyouts, sort of high-profile deals that haven't gone to plan. But that the heartland of the private equity market and the private equity industry in the UK is ultimately helping SMEs grow. I mean, that's why we exist. That's why pension funds commit their money to us for a long period of time. And without that growth, there's no reason for us to exist, and we're not doing our job. So, on average, our portfolio would triple at least in scale, would probably go from being UK focused business to at least operating in 2 or 3 international jurisdictions, which brings with it lots of career opportunities for the people, and an ability for founders to pursue their own vision, with the support of a partner and capital that we can bring to the table, rather than perhaps be, part of someone else's vision as a consolidated smaller part of a much bigger conglomerate.
Yeah, certainly when I alluded to the fact that a lot of people do kind of turn their nose up at private equity and kind of think, oh gosh, no, I couldn't possibly sell to them, and it is misunderstood. And I think a lot of people think you're just going to come in and strip loads of costs out, whereas actually, of course, it is all about growth, isn't it? and certainly that's the journey that you're on with TMP.
Absolutely.
So Matt, I mean, what is your plan to grow the business now that Horizon have invested in you? So obviously you've made investments in Omobono and Kingpin already, and they happened, in fairly short order after you got your original investment. Were those acquisitions that you were already sort of considering before you did the deal with Horizon?
Yeah, we'd sort of started conversations as we were in the last couple of months with Horizon of completing our deal, and it's a really important part of the process for us and Horizon, because it's effectively testing the thesis. Adam talked about fragmentation in the market, and you can theorize about that and do research into it, but it's not until you actually get into the market and understand, is there appetite to join this business and join businesses together, that you realize whether it's actually going to happen or not. So it was an important part of testing the thesis before we did the deal, to have those early conversations. And we were incredibly fortunate that 2 really good deals came along at the same time. Say fortunate, I might not have told you that at the time. It's because it's hard work, and I'm sure Damien can talk to that more in terms of his experience. But incredibly fortunate, 2 incredible businesses of high quality and really good scale came along. And really, actually, what that's helped us do is it's actually crystallized our vision even more than it did before we did it, because it's given us a real foundation of scale, and it's given us a much stronger capability set, because Kingpin brings us media. We didn't have media before. Omobono brings us digital experiences, a lot more digital and creative capability, where we were weak before as well. So now we can really focus on the areas that are going to plug the remaining gaps for this phase of the vision. And that goes a bit to your question about kind of, what's the strategy, what's the plan. For me, it's about continuing the journey that you've been on for a period of time as a business, staying true to those principles I talked about earlier on, having a 7-10 year horizon on where you want to get to over that period of time, and we've got that. And then the way I see the private equity piece is Horizon are our partner for the current phase of that, and that might last 2 years, it might last 5 years, it might last 7 years, but really we're building a plan for the business that goes beyond Horizon Capital. And that's a really important motivator for me and for our team, that actually starts to become less important that it's private equity, less important about who that is. It's actually about where the business is trying to go. So for us now from here, it's very much about a bit more capability add, particularly in the MarTech space, where we need to strengthen, and then very much a geographic piece for us. We're quite UK centric at the moment. We've got the offices internationally, but we're going to be investing in international growth, both inorganic and organic, and following on that pathway. So yeah.
And how was the process of acquiring Omobono, and how sort of heavily involved were you in that? Did it differ much from the process of selling to Horizon versus buying Omobono? Does it feel different?
Yeah, I led a lot of the process, partly because I was sort of intrigued to do so and learn about it. And it was quite different in the sense that, and I'm sure Adam will come on to explain this a bit, but TMP was very much the kind of platform, and I hate the language, but Omobono and Kingpin being the kind of bolt-ons, and I really do hate that language, but
no one wants to call a bolt-on.
It's probably one of the things that we're never going to be able to reconcile, like the kind of language differences between marketing and private equity. Therefore, the diligence that Horizon did on TMP was a lot more comprehensive, and it was a longer process. And what that meant was, when we went to do it with Omobono and Kingpin, because we know the market, because we know the business, we can get into it and very quickly understand whether it's a business of quality, the client relationships, far faster than Horizon could when they did that diligence on us. So it was a much easier and speedier process. Very different moving from seller into buyer. And I think I was very conscious that I still had probably a bit too much kind of empathy for the seller's position, and was trying to make sure that process felt really positive, because I think one of the things that's different about our sector from, say, some of Horizon's other sectors that they focus on, like particularly in the tech world, is because all of the businesses that we will ever acquire are people businesses. An awful lot of it is about the relationship we build through that process. And do you get to the end of that relatively painful diligence process, and are you still friends, and do you still want to work with one another? Whereas I think in the tech world, there's not as much focus on that, because you're often buying a product or a customer set. I'm massively oversimplifying here. So it was quite important to us that process felt as positive as it could to the sellers, and that we came out of that with a real momentum and energy moving forward, to carry the businesses forward. And I think we have done that really well. And we've got good momentum that we're going to sort of build on from here.
And presumably, Adam, you were sort of supportive throughout that acquisition process. And
yeah, absolutely. So we work very closely. I mean, we do quite a few. We help the portfolio buy around 25 businesses a year at a whole level, and there are very different levels of M&A experience depending on how much the founders have done or the management teams have done before, and we can be as hands-on as required, or hands-off if it's deal number 12 and they're just a machine, you know. So I think with Matt and the guys, we work very closely together, and Matt, you know, play a very important role on the stakeholder management and selling the vision of TNP, and coming on board to be part of that vision, and similar in the case of Strat 7. But hopefully we bring a bit of process, trusted advisors who've done, you know, we've done lots of work with before, who can de-risk that journey, because we've seen lots of buy and builds and businesses that have scaled from below 5 million of EBITDA to 15, 20 and 30 of EBITDA. So we've seen what works and doesn't work on that journey. So hopefully that relationship becomes 1 + 1 = 3, which is, you know, you de-risk that experience, and the management teams get a lot more experience and are able to stand on their own 2 feet the more that you do. So yeah, I hopefully Matt would reiterate that, you know, we work very much as a team on all of these things to be a supportive partner, and not just write the check.
I think it's an important part of going back to that question about, you know, choosing a private equity partner. The sense I got from the diligence we did was that there's sort of two extremes, right? There's private equity partners who will lean in very heavily, probably be a bit too involved for what I would be comfortable with, very much want to be in the operational side of the business. And then there's private equity that's very much hands off, leaves you to it completely, but probably therefore isn't as supportive as it could be. And it was really important to us that we found a partner who was somewhere in the middle of that, in terms of lean in when we need it, where we don't have the skills, like in M&A, but really lean back when we know what we're doing in terms of running the business. And it's one of the things that I think Horizon are really good at, is getting that balance right, trusting the management team to know what they're doing, but also stepping in when there's lack of experience. And that was important for us.
Yes, because presumably they're buying you because you're already a pretty successful, well-honed outfit. So there shouldn't be the need for too much interference, other than particular things that you've never done before, like M&A. Yeah. That makes entire sense. Adam, I was going to ask, actually, I meant to ask at the beginning, typically how long would the process start? So from sort of, I mean, not necessarily just with TNP, but, you know, from somebody having conversations with you to a deal completing, what's a typical time frame? And does it differ much from a trade sale time frame?
As we've seen, it can differ across different situations. I would suggest it can be quicker than a trade sale, just because we, as you know, our living is to find good investments, make good investments, help businesses grow through acquisition. So we spend all our lives doing this, and we have to become quite sort of well-oiled machines. Equally, that said, it's really important that there's two-way chemistry built over a good period of time, because it is a partnership. It is like being married for 4 or 5 years, 3 years, however long it is, and doing that quickly within the constraints of a process where you can't get to know people so well is more of a challenge. So I think, you know, the one thing I would say to anyone is really do your homework, like Matt did and the TNP guys did, in terms of who the partner is, because ultimately it's a people business, and you're teaming up with a small group of people, and it's really important that you know how you can how that party behaves in the tough times as well as the good times, because it's easy if everything's going well. But on average, it could be anywhere from, you know, a few months to 12 months. It's all about preparation, how well prepared you are. That can clearly reduce the timescales it takes to do a transaction. But I would think on average, private equity could move quicker than trade typically.
Mm-hmm.
I'd say for the two that we've done, from first conversation to signing, one of them took 8 weeks, one of them took about 20 weeks, or maybe more than that. There's a massive range there. There's various factors that play into that. It's not that one's necessarily more complicated than another. It comes down to the appetite of both teams to get it done quickly or not. And you can certainly be driven by that. And it can be fast, I think, without compromising on the process.
8 weeks is probably the quickest you're ever going to get it done, though, right? I would have thought.
I think so.
Pretty good going.
Yeah.
It's pretty good going. I had a question come in. So the question reads like this. It says, it seems to me that I would have to identify a company that I want to buy in order to sell my own to private equity to satisfy their requirements. I'm not sure that's necessarily the case, is it, Adam? But maybe you answer that a bit more fully. No,
not at all. So we want to build sort of a partner around what we call the platform. So in the case of the marketing of TNP, it was a platform business for us, and we were very comfortable backing Matt and his team to grow that business with or without M&A. We always think that's a good upside if there's an M&A opportunity there to help scale that business a bit more quickly and add capability and add more value to customers. So we do a lot of that heavy lifting ourselves before we make an investment, and therefore can take that bandwidth, it's only a burden and bandwidth away from teams pre-deal and even post-deal if needed. But certainly it wouldn't be a prerequisite to making that original investment. It's an upside to the equity story that we all benefit from, because why consider a deal like this would be an economic argument, which is you could sell the business in one go to trade, probably with an element of earn out and handover that you would need to do, or there's a two-phased exit with a private equity partner where you de-risk financially day one, but you reinvest alongside the private equity partner, and you try and take the business from 4 to 20 of EBITDA and more international with more services, and create a much more valuable business with the support of a partner and the capital than perhaps would otherwise be the case if the status quo continued for a period of a few years. And at that point, financially benefit from exit number 2, which when you add the two together would typically, in all of the cases that we see and work with, would be materially higher than economically than that one single exit day one. Obviously, there's also the important considerations around people, which we touched on, career opportunities, the excitement of the journey, having a much longer vision that Matt has than just 2-3 years. We've had businesses that have gone on to be founder owned, to same founders still in situ, and the business is a £2 billion business. So you can build a legacy with a private equity partner that can endure and be larger than perhaps would otherwise be the case. But it's certainly not a prerequisite to have other acquisitions lined up to be able to take on board an investment. Great, thank you, Adam. Conscious I haven't asked you anything yet, Damien. So you've advised on your fair share of private equity deals. What sort of questions typically come up when you're talking to clients who are considering PE?
Well, thanks, Esther, and also thanks again to everyone who's joining our webinar today as well. Look, it's changed enormously, and you can see from Dan Lehman's earlier slides that the appetite really that's driving vendors, driving marketing services and media companies together with private equity is stronger than it ever has been. If I think back to the last number of years, what used to be appetite used to be fear. Okay. And 10 years ago, people were afraid of the unknown. I think that they were, the points you're making about turning up their nose, or private equity guys being regarded as being a little bit smug and a bit arrogant. That really was the case, and I think the private equity's done a pretty good job to turn that fear into intrigue, and to have it as something which an advisor like us can include private equity as a serious option on the table, along with trade and with other kinds of investment, other classes of investor as well. I was reading about a European-wide private equity conference that was held in Germany a few weeks ago. So these were featuring the great and the good of the private equity world, the KKRs and the Carlyle groups, etc. I think one of the people at that conference that described private equity firms as locusts, a plague of locusts, sort of stripping vegetation, out of the environment. And others said, no, we're not locusts. We're more like worker bees. We work together with management teams, and it's all terrific. I think there is a job to be done there in terms of the reputational side of PE, and perhaps a certain irony now that seeing marketing services and PR companies getting together with private equity, maybe a lot can be done to maybe enhance that image. But for me, Guy Hans, who's a name known to a lot of people here, I guess, Guy Hans is the founder of Terra Firma. He simply described private equity firms as business people who are looking to succeed. And I think that's why we're seeing more and more private equity interest out there with media and with marketing services. I think the fact that private equity are actually paying a bit more than trade at the moment is very, very exciting for a lot of people. Adam has also referred to the fact that this is not a one-off situation. This is having more than one bite of the cherry. So, and that's a very, very intriguing and very exciting path for entrepreneurs and business owners to go down. So, look, it's changing all the time. It's definitely got a lot better. The questions we used to get asked were, well, what is private equity? How much do they charge? Are they going to rip the ass out of this company? These are all things which have definitely improved. I think private equity companies are doing a much, much better job of now than they were, pre-pandemic. Just one thing about the jobs I just wanted to mention. It was an interesting piece that I noticed in my own research. That is the National Bureau of Economic Research in the States. We're looking at this particular impact of job creation or job destruction based on the involvement of private equity. And it's actually an interesting read, because it turns out that a company going from public to private, they're on average losing about 13%, 13% of all the jobs. Where if you look at private to private, it's actually 13% plus. So private equity as a catalyst for job creation, I think, is definitely depends on what the actual nature of and status of that company is. It's not one size fits all. What else could I say? When private equity is becoming incredibly competitive, Adam, you'll know this, how many firms are out there. I think at the last count in London alone, there are 690 private equity firms out there. So it's no surprise that it's coming onto the agenda more and more. I hope that helps.
Yeah, no, that's great. Thank you. So Adam, how does it feel to be described as a plague of locusts? And what would your response be to people who view private equity as the bad guys?
Yeah, look, we meet a lot of suspicion. We meet a lot of founders, and there's always suspicion. And it is coloured, I think, by the very large deals that have been done in the last 10, 20 years, and maybe haven't gone to plan and been high profile. But as I say, the reason the industry exists is basically growth, and pension funds achieve their returns because we help grow businesses, and that is really important. And yes, there'll be some bad and there'll be some good, just like in any industry. But the heartland of taking small businesses, attracting investment from overseas, and helping those UK businesses grow more quickly and internationally and create jobs. I love doing this job because it is very rewarding and satisfying when you do that. So I would say speak to people who've been through it, speak to people who've been through it with particular partners that you're talking to, because it's a group, it's the sum of lots of small groups of people. We're an owner managed business ourselves. We invest personally in every investment we make. We've invested in 14 businesses over the years and had lots of success stories over that journey. We've had some that haven't gone to plan, and we've had to really dig in and support them. And every investment we make really matters, and it's how you behave in all of those situations that that matters. And it's a small world, so you can find that sort of information out from speaking to people, asking to reference people they've invested with before. And I think it's something any founder should at least consider. And I'm not just saying that, but put myself in that situation. I'd like to understand whether 1 + 1 can equal 3 versus the sort of, and can I build out that legacy and the opportunities for my team versus that clean trade deal. And you'd certainly want to understand whether that's an option as well.
I think it also comes down to the purity of intent. The thing about private equity is you know exactly what they're trying to do. They're trying to make money. And it's that simple. So if you feel confident in your business and you've got a very clear plan for how you're going to make money with them, whatever happens along the journey, that plan will change, but you know what your job is. And the thing that I couldn't reconcile at the time, and this might change in the future for me and for the business, but what I couldn't reconcile about, say, the trade side, for example, was what is the intent? What are we trying to do? Am I connected really to the people who would be driving the business in that bigger organogram of a big group network agency? And I couldn't figure that out. And in private equity, I know what my job is. And as long as I deliver and we continue to deliver, it's just very clear for me. And I think, personally, I like that. And that might not be for everyone, but I do like that.
No, that's a really good point. Really good point.
Yeah, that point about purity and the sort of clear alignment is pretty pivotal to the entire model. And that goes from, our investors down to us investing, down to the management and the vendors. We're all invested in the success of a business and the failure of a business, but we all share in success. And so that's quite a pure, simple model. Everyone is driving for an end goal and trying to do it probably more quickly than you could otherwise do it. And that's exciting. It's fun. And the journey that these businesses go on is full of lots of excitement and change.
Got a couple of questions come in. One is around percentage. So typically when selling to private equity, what percentage of your business would you be selling? And another around sort of typical timescales for a secondary event.
Shall I take that? It can vary anywhere from a minority stake up to a majority stake. So there's solutions out there in our world that will provide for all of that. We would do both. We would always want people sharing in the economic success who are driving the value in the business. So it would, management will always hold a share in that equity upside. But it depends on the motivations of the founders. If it's more towards higher cash out day one, then there'd be more of a majority. If it's more towards, building something 5 times bigger and you need some more capital to do that, it'd be more towards a majority. If it's just an earlier stage, smaller de-risking, it would probably be more like a minority. In terms of timescales, there's no set timescale. I can tell you what's typical, and typical is probably anywhere between 3 to 5 years, and it absolutely can go quicker, and it can sometimes take a little longer, but that would be the average.
Thank you, Adam. And another question, which I guess it's probably either for Damien or Adam to answer, is it's quite a specific question, but I think it is an interesting one, sort of around the sort of the legals of a deal. They've asked sort of, with all the warranties and the liabilities that you do, are there any differences really between a PE deal and a trade sale in that respect?
Depends. It's a good question. Thanks, Richard, for the question. Look, it depends entirely on the deal and the characters around the table. There are so many complexities depending on the provenance of the offer, the type of way in which the private equity firm runs its own program of documentation. There's also all the various debt instruments to be taken into consideration as well. There's definitely, look, we know paper has never refused ink. It's one of the changes I'd really hope to see in the next 10 years out of the private equity. In fact, out of the whole investment area. We find sort of with some of these technology investments we're making, perhaps we can find a much cleaner, faster, and actually more, collaborative way of making all this happen. It is better than it used to be, there's no doubt. But I don't think that any one deal or any two deals are the same as each other. As Adam has said repeatedly, this is about people. It's not about numbers. It's not about spreadsheets. And you know, I think an increasing number of people out there believe that private equity is, you know, will be the catalyst for wealth creation in this country over the next 10 years.
And what about deal structure as well? Because obviously in the sort of the big networks, there's a fairly tried and tested route of, you know, upfront amount with an earn out that might be something like 3 years. Do private equity houses tend to follow similar deal structures?
No. I think that, as I said, every deal is entirely different. I think that the trade, you know, type purchase, you're much more inclined to see, you know, earnouts in a trade environment than private equity. I mean, essentially, you know, the best private equity deals that I see are the ones that just get those two agendas merged into one very, very quickly. They have to be on the same side. And I think that one of the things I don't like about earnouts in particular is that I think that a vendor can often find themselves, you know, having divided loyalties. In fact, having to look over their shoulders, you know, how they're going to realize the rest of the value out of their deal. And I think that particularly given private equity, you know, tends to veer towards a majority share in deals, I think that there's less emphasis on earnout.
Yeah, different kind of relationship, isn't it?
Yeah. Be interested to hear what Adam has to say in particular, you know, about that.
Yeah, no, it'd be more typical in our world for vendors, partners, and managers to have equity upside that's uncapped. You know,
yeah.
based on shared growth in the business. So if you're selling out to a trade, there's probably more likely to be an element of day one and a capped earn out of some sort. But if you create loads of value over 3, 4, 5 years, you know, maybe you don't get that upside. Whereas in a private equity structure, you still can de-risk through cash out day one, but you know, generate quite significant upside through a retained equity stake in that business. And benefit from some of those further investments, be that in attracting more talent, investing in solutions, sales and marketing, growing out international reach, making acquisitions, you know, working with the partner and their capital to do that.
Yeah, agreed.
I'm sorry, go on.
No, I was just going to say that again, I think we're in a very, very changing world at the moment. You know, we're seeing much more imagination coming into the shape of these deals. There was quite an adherence to the traditional 10-year model of private equity, and I think that's been, you know, challenged more and more as the years rolled by. Greater flexibility on exit, greater flexibility on liquidity and recapitalization, all those elements. And again, I think technology has got a huge part to play in this, as to, you know, how you know, shareholders might change and investors might change, how the actual ecosystem of a deal will evolve in the future. So I'm really interested to see how, you know, where do we go from here? Because remember this, I mean, private equity didn't really exist 50 years ago. So it's relatively speaking, you know, in terms of financial services, it's relatively young.
There's one more question here. Oh, it might be two actually. What sort of ROI percentage would a PE buyer typically be looking to make on their investment?
Great question. I mean, we'd always try and develop a plan together with the teams that would see us all collectively making 3 times the day one invested amount. 3 times return over time is what you target, and that's not us making that return at the expense of other shareholders. As I say, the alignment of the structures that you put in place with a private equity house means everyone benefits from that. But we want to at least triple the value of every investment over time, and that, you know, that's only possible with growth, and again, supporting those businesses to get to a level at which, you know, they attract that next group of buyers higher up.
I've just had a thank you from an interesting discussion. Please get I won't say who it was.
Hey, we've converted somebody.
Another interesting question, actually. How do you assess the value of a company in 2021 in terms of, you know, what's changed via COVID? Are you looking at growth potential, EBITDA, you know, recurring revenue streams? What's important? probably a mixture of all of the above. Not yet, he says, not quite converted.
Well, have to work harder. Mr. Alcon. Yeah.
A great question. Matt, you can give your perspective as an operator as well. My perspective is, the degree to which a business has been able to weather the shock of a global pandemic that, and a business shock that none of us have ever seen the likes of, is a massive endorsement of the quality and the resilience through any cycle. So we accept most businesses would have been impacted in some shape or form, but if they've come through it with an element of resilience, and with a good business to grow on the out through the other side, then I think that's a positive. It's not a detractor of value if it's smaller than it was, but it's come through well. We're EBITDA focused in terms of how we value businesses. What multiple you apply to that is dependent on so many things, from how big and how robust the business is, the quality of the revenues, do the customers keep coming back, or is it sort of one-off? Is there customer concentration? What's the growth? What's the sort of the extent of the team and the depth and quality in the team in a business? How big is the market? There's no exact science, but the multiple is a reflection of all of those things from our side. Matt, if you've got any other perspectives to add to that.
Yeah, I'd echo that. I think the first things that we look at are the organic growth. Is the business growing? Is it growing 20% plus? That's what's going to make us most excited. And then, it partly depends on what you already have and the capability and how much you sort of value that capability. But I think for us, certainly the team is a really important part of it. The senior team, the intent of the senior team in the future is an important part of it. Rationalizing that. That's be the other bit I'd sort of throw in there as an important qualifier for us.
What about, Matt, what about ESG creds? They're becoming increasingly important. How does that sort of play into your business? And I guess, and then secondly to Adam, do you pay attention to, is that a factor in valuing businesses or whether they're an attractive acquisition?
My instinct, and I'll have a better view on this, is that it's unfortunately not a value creator now, but it will and should be in the future. And I think we're on that journey. I think in our sector, I think we're ahead of the private equity sector anyway, because I think particularly D&I and community focus has been an issue for us for a long time. It's something our employees care about an awful lot. So we've had to have the right strategy around that already. So I think on that side, we're sort of ahead of where some of the private equity market is. The ESG thing is really interesting because there's quite a few bits that come out of it, from the PE side around carbon neutrality, responsibility, etc., which doesn't feel quite as relevant for our sector because we don't manufacture anything. No one's travelled for the last 2 years. So for us, ESG is basically D&I, and the makeup of our employee demographics is probably 80% of it for us.
Yeah, I think it's got huge implications for private equity, Esther. One only has to take a look at the growth of impact investing in around the world in the last sort of 3 to 5 years to see that. And so I think that we're also seeing it on the advisory side, but certainly looking around at some of the challenges that face private equity, perhaps in the US market in particular, that ESG and D&I, as Matt has said, is becoming more and more important. But I think that this is very much consumer driven. Consumers and investors and pension funds as investors will also want to see what this PE firm is all about. What do they stand for? What's their common purpose, and what good are they doing as well? So I think it's certainly when one looks at how private equity might change, how it has changed in the last 10 years, and how it will continue to evolve in the next 10 years. I think that's going to be a really key aspect of it.
That's great, thank you. I'm conscious we're pretty much at the witching hour, so I've cut you off, Adam. I'm going to go last with just one top tip from each of you on what tip would you have for a business looking to get investment or exit, if they're considering private equity, in any order.
I would just throw in, here's the 3 questions that I would ask. If I was thinking of selling to private equity, or even if I was getting approached by private equity, I would ask them, why us? What is it about us that makes you interested? I'd want to know how many investments is each partner in the private equity firm taking on, because if you're not getting their mind share, well then, it's not going to work, in my view. And I would also ask them for references. Very, very simple. Give me a list of people that I can call that will tell me what you really like to work with.
Great, I'll have those. That's 3.
Yeah, I think I'd just reiterate, it's fit and chemistry, and do your homework. Yeah, that's really important in choosing a partner.
Yeah, and for me, for more of a general tip for anyone selling, I think really thinking hard now about what you need to do to get the business ready for it. I think that is fundamental, and that could just be about shift of culture, leadership, messaging. We've seen quite a contrast there between businesses that our business are required in terms of how ready they are, and that's an important step, I think.
Brilliant. Well, thank you all so much, and thank you, Dan, as well. That's been a really interesting session, I think. So just to remind everyone, we have recorded it. We will be circulating it. Please do share it with colleagues and peers. And that's it from us. So enjoy the rest of your day. Thank you very much.
Thanks, Esther.